Welcome out tonight to this installment of Money Talks. Very happy to be here. My name is Gavin Gillas, and I'll be your moderator tonight. I'm the co-founder of Giving Docs and an entrepreneur in residence at the Kelleher Center. It is my pleasure tonight to introduce to you Brad Bentz from ATX Seed Ventures. Brad and I met for the first time a couple months ago, and he's a modern Indiana Jones. He used to be an archaeologist for reals. 10 years in Syria, Pakistan, and then became a web developer because it's really easy to go from archaeology to web development. And then got into the private equity world and deployed about $72 million in deals, working with IDG and I'm going to blank on it, Boston Consulting Group. And he's now one of the partners at ATX Seed Ventures. And they've done a lot of local venture investing. Companies include Bracklet, Set.fm, Ride Scout, and Everfest. And yeah, Brad's a huge source of knowledge. So I'm here tonight to really just let him talk. But I wanted to start with some questions for Brad and let him clarify anything that I screwed up. So Brad, you want to talk a little bit more about yourself and your story, how you got to Austin?
Thanks. I'm really pleased to be here tonight and appreciate the opportunity to talk to everybody. I actually grew up in Austin.
Right on.
Graduated high school here back in '85 and have lived in many other parts of the country and have lived abroad for a while, and then moved back about 3 years ago when I joined ATX. So I'm glad to be back. Austin's a special place, and it's an exciting town, and there's a lot of great stuff going on here.
Fantastic. By show of hands, who's here because they either have a startup or they're interested in starting their own company? Almost all the hands. This is great. So this is the real treat tonight. I've picked Brad's brain before. I think he's incredibly knowledgeable here. And the cool things about being a venture investor is they see a lot of deals. So they know a lot of things that work and they know a lot of things that don't work. So it's a privilege to have him here tonight. When you look across different projects, startups, deals, what are some of the traits you see or patterns you see that indicate early potential for success?
So are we talking about just the company itself or the team?
Or the founders,
Yeah. So I think about that in a number of different ways. So when we look at founding teams, part of it is that we're looking for individual sort of character traits of the founders, but we're also looking for how the founding team complements each other and has the right set of skills to actually make a go of the venture and hopefully be successful with it. So one of the most important sort of personal traits that I see in founders that are successful is empathy. Just by that I mean not so much sympathy for the people, but the ability to look at a problem from somebody else's perspective. And I think that's so critical if you're an entrepreneur, to be able to try to figure out what is it that other people are looking for and then be able to craft a solution that addresses those needs. And so empathy is a really important starting point to have as a founder, because if you don't have that, then it's really hard to figure out what to bring to market that's going to actually address an important problem that people are trying to solve.
Oh, that's a really good point. So empathy would be maybe high on your list. What would be some of the other general skills that you'd want to see among founders?
Well, I think domain expertise is incredibly important. I think particularly if you're a first-time founder and you're not coming from industry, it's really hard for me to see how you're going to be successful. I mean, there's always the cases of people that have overcome those odds, but as a venture investor, we're trying to play with the odds, not against them.
Gotcha.
And so definitely want to have somebody that's coming from the industry and has that insider knowledge. They know they know what customers are looking for. They know who the important players are in the industry, who the potential partners are. They have relationships already kind of built in that they're bringing with them. And so those relationships and that insider knowledge are really critical, I think, to success.
So I sit down with a lot of student entrepreneurs, and they sometimes pitch what I call student problems, and those are good and they're valid, but they're sometimes not the bigger things that they could work on or the better opportunities for real growth. If I'm 20 years old and I'm still in college, how would you recommend I get towards that domain expertise? How do I get that deep industry knowledge?
Well, I think, getting out of school and working in a particular field for a while and getting those relationships and getting that insider knowledge are really important. So I don't know that it's the best idea to try and come out right out of the gate as an undergrad or new graduate with a product idea and see how it goes. I mean, obviously there are people who do that and they can be successful at it. But there are many more that try and fail at that approach. So I would say, get at least 4 or 5 years of experience in an industry.
Right.
I think that's probably enough depth to really know, because you're going to pay one way or the other.
Right.
You're going to either pay the dumb tax or you're going to leverage the investments that you made in getting to know the industry from the inside.
Right. So you either have to learn it outside of the startup or inside of the startup.
Right.
Yeah.
But you're gonna spend that time one way or the other.
Gotcha.
So
speaking of paying the dumb tax, I've definitely paid it, time and time again. From your seat at the table, have you ever made a wrong call or kicked yourself after making a decision?
Yeah, where to start?
We'll take the rest of the time on this.
One of the problems as a venture investor though is that some of your bad mistakes don't become apparent for several years. And so we're still kind of early in the process. So we've had a few companies that have wound up from our existing fund, but there's some more landmines out there that we might not even realize until later. And so that can really hurt you as an investor because the ship's already sailed. You've already made some other investment decisions that if you had known how it was going to play out, you might have made differently. But one of the problems that we made with a couple of our investments that now that we're talking about sort of pattern recognition and what can go wrong, and this can be helpful to entrepreneurs, not just investors, is leaning too much on channel partners. So we've had a couple of startups that we backed where they put all their eggs in one basket. They thought, look, we've got this big channel partner, it's a big company, they've got a lot of muscle behind them, they're invested in our success, and they're going to open a lot of doors, we're going to ride their coattails. And it sounds great. The problem that we realized is that what's a big deal to you is not a big deal to a giant company, right? Even if they put money into you, it may be such a small part of their overall budget that they don't really care about the outcome. And so for us, it meant everything. And for the entrepreneurs, the outcome meant everything. But for the companies that we were partnered with, it was just kind of a rounding error. And I think that's where we went wrong on those two investments.
Good advice. I've been there. Tell me more about I want to circle back to that thing on empathy as well. We talked about how to develop a bit more of the industry expertise, but what about empathy? How can you go about learning how to, understand better and ask better questions? I mean,
okay, I'm not a psychologist, but I firmly believe that empathy is a skill or like a muscle that you can train. So no matter where you are, I think you can get better at it. And I think part of getting better at it is just making a concerted effort to do that. And to be inquisitive and to ask, people what are you working on? What's a problem for you? How can we solve that? Just having that natural inquisitiveness can go a long way towards, building that skill. Awesome. And also trying to get out of your own shoes and look at a problem from someone else's perspective. I mean, that's what you're trying to do, but it's a matter of practicing and making the effort. And that's actually a skill that I think is transferable from my background as a social scientist, because that's what we're trying to do as well. We're trying to understand other people.
Right.
Whether you're a sociologist or anthropologist or a psychologist.
You're trying to predict behavior.
Right.
Yeah.
Or to study behavior.
Yeah.
And as a marketer or as an entrepreneur, you're trying to do the same thing with a slightly different goal.
Right.
But at the end of the day, you're trying to understand and predict behavior.
Interesting. So when you look, and I've heard this from HR leaders before, they can look at a resume and in 10 seconds make a pretty quick determination.
Yeah.
You might have the same superpower with pitch decks or early investment documents. Are there any things that are glaring, no-nos that you see when people either walk up to you and pitch you their idea, or they send you their deck or materials?
Yeah, there's a few. One of them that is kind of a pet peeve of mine is when people inevitably have a slide about the addressable market, And I understand that there can be some differences of opinion about exactly what that means, but I'll give you sort of a fictional example. Like, let's say you're talking about a pitch deck of a company that does, B2B travel software so that companies can manage their employees' travel and expenses and reporting and all of that. And so the TAM slide in that deck might say, travel is a $500 billion industry. And they're giving you the total spend in the category, including what consumers are spending on flights and hotels and meals and all of that, and they're lumping all of that together, and it makes absolutely no sense to it. It's totally unhelpful to me as an investor,
Right.
Because I'm trying to understand what is the market size for travel software, not
Right.
what is the total spend in the travel category,
Right.
of which software might just be a tiny little sliver.
What is the total spend that people make outside of their
Right.
house?
And they're basically trying to pump up the market to make it seem really
Bigger,
big and
yeah.
exciting. It either makes them look clueless or it makes them look manipulative. And
Right.
neither one really leaves the right impression.
Those aren't good signals. Yeah.
Yeah, exactly.
And then they tell you how they can attack 1% of it every year.
Right. So, then it's the assumption, well, if it's this huge market and we're only going to, capture, we only need 2% to make this a fantastically large company with no real meat on the bone of like how they're actually going to go to market and achieve that.
Yeah.
Just an assumption that, well, 2% is a reasonable market share to have for this enormous market that we're going to address.
Gotcha.
So that's a very common issue that always drives me nuts when I see that.
Yeah. So on the flip side of that, what are the things that stand out to you when you see those early pitches or that early material that really does inspire credibility?
Yeah, so I want to see reasonableness and assumptions. I want to see where possible, how did I get to that number? What is it based on, even if it's kind of very briefly stated or there's a link to some outside sources where I can kind of independently verify some of the information that's being presented to me. That says a lot. If they have people on their advisory board that are people in industry that I've heard of, that also sends a really good signal that this is credible, because I can make some assumptions that those people are not going to waste their time on a project that doesn't have any merit.
Mm-hmm.
So if I see that there's some industry stalwarts that are involved as advisors, then that really gets me excited that there's probably something important happening here. And something that's not really in the materials, but that's really important to me is, how did they get that deck to me? Like, did they just, shotgun it to everybody, or did they actually, do some research on us as a firm and decide that we were a good fit? Because I pitch all kinds of stuff that a cursory review of our website would show that we don't do that.
Right.
And so, that's kind of a red flag from the beginning.
The quality of the introduction or how they got to you.
Right. I mean, even if they're just sending it blind, at least if they've shown that they've done some research about what we do, like,
Right.
They know that they're based in Texas and it's a software-based startup. That's at least kind of in our ballpark, so
Right.
we'll take a look at it.
Yep.
But to your point, we much prefer to have a warm introduction from someone that we trust. So that's the way most VCs prefer to be approached,
Right.
rather than being spammed
Yeah.
or cold called.
If you got nothing else from this whole time, just remember those last 5 bullets, and we can go back through it, because that was super important. I appreciate that.
Yeah.
So if I can recap, some of the signals that show a well thought out approach or a potential good company is, and I'm going to botch these, but they did do their homework on the market.
Right.
They present credible numbers and a credible approach to get there.
Yep.
They were able to assemble advisors that are of recognition or have credibility in that industry. And then they came to you through either some research on the correctness and fit for your fund, or through a warm introduction.
Right. And something else that I think we could talk about that I see in decks is usually kind of the bios of the team members themselves. And so then we can kind of look at, okay, do they have the right profile in terms of domain expertise, but also a track record of success? Have they managed other people in the past? Have they had other startups? And do they have the right constellation of skills across the team? Because one of the red flags for me is there's a business founder that has some interesting expertise in the industry, but they don't really have anybody with technical skills on the team. And they just say, we're just going to outsource the whole technical aspect, including all the product management to some offshore development shop in Eastern Europe. To me, that's just like, oh God. I mean, maybe it'll work, but I've seen a lot of companies go down in flames because of that.
Right.
And so I think it's really important to have a technical co-founder who has the right skill set to be able to pull off what they're trying to do and can manage it in-house. Now, if you want to use some outside developers, that's fine, but at least you've got people in-house that are accountable and actually have skin in the game,
Right.
who are going to lead the sort of technical charge and make sure that gets done and gets managed properly. And I think that's really important. And I actually like to see the development happen in-house in the early process, because it's just much more efficient to be able to iterate quickly if you've got your development team in one room. Mm-hmm. And then later, when you're starting to scale up, then it's more about cost control. And maybe we can outsource some of this to lower the cost. But I think it's kind of money wasted if you're trying to save money at the very beginning, and yet you're wasting a lot of time because your development team is 8 time zones away from you.
Correct. And that's an interesting point, is that being close to your product early on, is you would think that would be risky in some scenarios, but actually, you want that credibility. You want people to eat their own dog food and understand their problems first before they try and scale or overbuild or send it across the globe. Yeah,
absolutely. Another kind of red flag for me is you see, too many people on the org chart early on.
Yeah.
Like at the stage that we're looking at, which is usually either pre-revenue or very early revenue, I expect everybody who's involved on a full-time basis to either be making something or selling something. And if there's anybody that's not doing one of those things, like, why are they there? Why aren't you? I mean, if you're going to outsource something, it should be like HR or part-time CFO, something like that.
Yeah.
And then when you get a little bit further along, it makes sense to have those people in-house. But it's kind of a big red flag to me when they've already got all these, departments that have been fleshed out with, senior VP, finance. Like, why do you have this person on your team at this stage?
Yeah. So if I can wear my mentor hat for a minute and editorialize that, you're in control of your bio on the pitch deck. You're in school and you get to decide, what your expertise is. So if you're not a maker or a seller, consider that. Think about that. Because that's the part you can control. You can't control, outside forces, things like that, but you can control your own skill set and bio. So that just hit me there. I thought, that is something that you all can be doing. You can't necessarily predict everything else, but you can take care of your own credibility. So one thing that I'm interested in is, like, when is the right time for funding? Are there times when you shouldn't look for funding?
Yeah. So the way I think about it is, venture is a particular kind of capital, and it's appropriate for certain types of companies. So there are some companies that, are more lifestyle businesses, or it's in a slower growing, more mature industry where venture is not even really the right fit to begin with. And then the question is, when do you approach venture investors? And, it shouldn't be at the PowerPoint stage. Like, you just got an idea, and I don't know where this mythology comes from, that you just kind of come with a cool idea and then you shotgun a bunch of venture funds and then you get a big check in the mail. It just doesn't work like that. We don't want to take technology risks. We want to actually see that the technology is feasible and that the team can actually build it. We'd rather wait until there's a finished product and we've already gotten some evidence that customers like it. Either preferably they're writing a check, but even if they're not writing a check, at least they're using and we can gather feedback. So, at the conceptual stage, or even when you're getting your first pilot deployments, it's very hard for a venture investor to kind of get their arms around, how much technology and market risk is there in the venture at that stage. So, venture investors are stewards of other people's capital, so we have to be a little more conservative about who we're funding. So typically what we see is that, when you're at that stage, you do a friends and family round, or you go and get some individual angels that want to take on that little bit of extra risk to get that first version, the MVP product, built, and then get some customers actually using it. And then you can start having those initial conversations with venture investors. And they'll tell you if it's like, still too early for us, but often that's when you want to start building those relationships. but at least have something that's working to be able to show people before you start approaching them.
So moving past the pitch deck or moving past the initial PowerPoint or back of the napkin and really distilling it down to, do you have a customer? Have you had customer conversations?
Exactly.
Taking a little bit more initiative to move it forward.
Yeah, we want to have some sort of proof points that we can hang our hat on to say, look, we don't really have enough data to say there's product market fit. I mean, I wouldn't make that kind of a statement when we're doing seed level investing. But we want to have some indication, early indications that it's heading in that direction. Right. And having customers that are paying you real money is the best validation that you can get. Fantastic. So we should have a strong bias for those types of opportunities where there's already somebody who's using the product and paying money for it. But we will sometimes lean a little bit upstream if we've at least got some pilot deployments and we can evaluate and talk to the customer directly to gauge their propensity to continue using the product and also gauge how well does the product address their need and how important is their need, because that's also a good leading indicator of their willingness to actually part with real dollars.
Excellent. One thing you said earlier was that as a venture capitalist, you're a steward of other people's money. And just kind of VC 101, could you explain for everyone, like, how does that work? How does your job work? Where does that money come from and what's expected of it? Yeah,
so we have to go out and raise money just like entrepreneurs do. We have many of the same challenges in terms of being able to get the money that we need to execute and run our play. VC funds vary a lot in size and focus and stage, and so they have different types of investors that back them. I mean, in some cases, it's high net worth individuals, which was what our first fund was largely financed by. Or you also have family offices, which are basically multi-generational wealth, where you might have an initial founder that started a company and did really well, and then they parlayed that into an organization that their children or their grandchildren might be a part of, where they're continuing to invest the family's money over time and they're diversifying it into different types of investments. So family offices are a really important source of funding, both for kind of seed stage venture funds, but also individual operating companies. They often make direct investments or co-invest with venture funds into that. And then there's the institutional LPs, who typically don't make direct investments in individual companies. So they can't manage that many relationships because they have a large pool of capital to deploy. And so they look for other managers to put chunks of that money to work. And so they'll typically have different types of asset classes that they invest in. So these are, we're talking institutional LPs that have billions under management that they put to work. And so it can range from a few billion to hundreds of billions, anywhere from small foundations to big, state pension funds or sovereign wealth funds. And so the bigger the LP, the more asset classes they're going to deploy across. Right. And typically what we see is that early stage venture is something that they get to kind of late in the game, because you want to check all the other boxes first. You want to have, public equities, and then public debt, and then real estate, and then later stage private equity. And then so the allocation to early stage equity is kind of a much smaller slice of the pie. But it's understandable. It's riskier, it's illiquid, and so they're not going to put 80% of their funds into that asset class.
Correct. Talk to me a little bit more about your fund, ATX Seed Ventures, specifically. Just like, if you're going to apply for a job right out of college, you would do some homework on the employer. You don't want to work for an employer that doesn't meet your values or doesn't have the type of opportunity you want to have. Likewise, if you're going to get funding, this is a partner you have through the growth of your company. So if I was doing my homework on ATX Seed Ventures, what stands out for your fund? What's the right size and the right approach and the right match for people or companies looking to work with your team?
Yeah, that's a great question. And the first thing I want to do is emphasize the partnership, because particularly if you're investing early on, you're going to be in that investment for a long time. So when we are looking at a deal, we're underwriting a 5 to 7 year relationship with the founding team. And that's longer than some marriages last. Mm-hmm. So we absolutely look at the relationship with the founders as a partnership. And one of the things that we're looking for is rapport. You know, would you want to do business with somebody? Are they easy to get along with? Are they coachable? Do they, is there trust? So those are critical kind of at an interpersonal level. And then in terms of the kind of deals that we're looking for, we have certain parameters that we seek out. So we have a very strong bias towards, in our current fund, towards serial founders. So it's not that first-time founders can't do a great job. We've got some first-time founders in Fund 1 that have done amazingly well. Just that our general experience has been that the first time you're running a company, it's just going to take you longer and more capital to get from point A to point B than if you've done it before. So repeat offenders typically do more with less faster. And that's been proven out so far in our second fund. And secondly, the other problem that we've had with first-time founders is that they, for understandable reasons, are very eager to take the first off-ramp that becomes available to them, which doesn't align with our interests.
Right.
So we are looking for big swings. We want to create a lot of enterprise value. And so if you take that early $10, $20 million exit, it can be great for the entrepreneur, but not necessarily what the venture investors are looking for.
Right.
So that's a big factor that we look at is have they had prior exits? And under the theory that they know what success looks like and they're more likely to be successful if they've shown that they can do it already, but B, because they've already made some money from their prior venture, and so they're not looking to get that first off-ramp in order to shore up their balance sheet or get validated that they're successful entrepreneurs because they've already done that. So that's a criterion that we spend a lot of time. And so if we're looking at a team that hasn't done that before, then it's a question of can we augment them in some way? Can we bring an advisor or bring an officer into the company that has that gray hair that can help lead the charge?
To augment that team so they can get closer to the thesis.
Right.
Yep.
Exactly.
Okay. Very cool. If I am a student here in the audience and I'm interested in startups, and I don't necessarily want to be a founder yet, but I want to get involved either as an intern or as an employee when I graduate, how should I as a student be evaluating different startups? I mean, one, where do I approach them? And two, how do I pick the good ones?
Okay. So, in terms of evaluating a startup to work for, if your goal is to get hired with a startup that's going someplace that's going to be successful, then you can probably focus on ones that have already raised an institutional round. Those are going to be ones that already have a little more traction in the market. But they're much more likely to have a successful outcome than one that's pre-revenue or hasn't raised any institutional money.
So when you see something like the Zebra has raised $40 million in a Series B, that's kind of passing that threshold where they're a safer company to go look at.
Exactly.
Okay.
Yeah. So it means that they probably have product market fit. They've got a fairly stable set of customers.
Versus Gavin's side project.
Okay. Right. Yeah. I mean, if you're being recruited to join a startup that's still at the idea stage, or they haven't actually gotten any revenue yet, those are the ones that are most likely to crash and burn. Not to say that you can't have a catastrophic failure later, but risk tends to go down over time as you get past more milestones and proof points.
We just gave one or two people in this audience their life back for like 2 years, if you heard that part. Okay, good point.
And there's a lot of companies that still position themselves as startups, even when they're, in my mind, way beyond that stage. But you can still say that you work for a startup and they've got 20 million in revenue. That still passes muster with a lot of people.
Yeah.
So just because you work for a startup doesn't mean it has to be pre-revenue.
If you could put your own startup anywhere in the U.S., why would it be Austin?
That's a really cool question. I think Austin has a lot going for it in terms of having a really collaborative environment. As my partner likes to say, we're the tallest midget because we're sort of, the leading sort of second-tier technology hub in the country outside of the coasts. And so there's a sense that people in Austin feel a little bit like the underdog and we have to try harder. And so it's not as cutthroat. I've found that people startups and investors they're just willing to collaborate a little more than they are other places, and that's great. And it's still, even though costs are going up compared to what Austin used to be 5 or 10 years ago, it's still much cheaper to start a company here than it is in a lot of other parts of the country. So that's another great benefit. And you can still raise money here. I mean, people complain about the lack of capital, but really there are half a dozen venture funds in town that do early stage. There's accelerators. There's seed funds. There's CTAN is one of the most active angel groups in the country. And so if people aren't getting funding, it often is more a reflection of the viability of their business model than it is about the lack of capital in the market. And also,
that's a controversial point, but yeah, I think that's
I have my own perspective, and I realize that people don't necessarily agree.
Yeah.
But another benefit of being in Austin is the fact that you're a little bit out of the spotlight, so you can afford to make some mistakes that you might not be able to make in a premier market like the Valley.
Right.
And people won't necessarily notice. And also, I think a great benefit of being here is that people push you to get a revenue model really early on in a way that they might not some other places. And what I'm talking about is in the coastal markets, there's sometimes this attitude that it's all about aggregating eyeballs, and then you figure out how to monetize it somewhere down the road. Or you just sell it to Google and they'll figure it out. That leads to really binary outcomes. Like you can be a unicorn or you can be a goose egg. There's not much in between.
Right.
Whereas here, the focus is really on let's get a product to market and let's start generating revenue as early as possible and prove the viability of the business. And I think you might not hit as many home runs that way, but you're not going to have as many failures either.
No, there's some certain honesty in generating cash flow.
Right.
Yep. Well, great. I have one last question, and then we have 2 mics opened up, and we're just going to take questions from the audience after this. So thank you for your patience. I'm going to shoot this last one over. So Brad, if you could highlight, one piece of technology or one emerging area or industry that you're particularly interested in, either as an investor or in personal interest, what would that be?
So there's been a lot of hype in the last year around blockchain, and I am not a blockchain or crypto expert by any means. But it's important to note that that's the position a lot of investors are in. So most investors are not technologists. They don't get their hands dirty with the technology. But as a startup founder, you're going to face the kind of scrutiny that you might get if you're launching something in a hot area like that. And so I'm really intrigued with the idea of blockchain as a distributed ledger for peer-to-peer transactions. And I'm really looking for interesting applications of it outside of the currency area. And I'm just now beginning to see some dribs and drabs coming in with decks that have that as part of it. But I've not yet seen a compelling use case
for it,
where it really this is absolutely the right solution for that problem. But
so get your blockchain down.
I'm expecting to see that in the next 12 months. I just haven't seen it yet.
Awesome. Excellent. Thank you so much. Brad, thanks for joining us tonight.
My pleasure.
So we're going to take questions for about 15 minutes from the audience, and then we'll close up formally so that you can chat one-on-one and network and mingle and find a co-founder and get funded and everything else you need to do tonight before you go to bed. So feel free to step up to the mic if you have questions.
So
Hi, Jacqueline.
Thanks for being here. Hey, thanks for being here tonight. So out of curiosity, how did you go from being in archaeology to software to venture capital?
Oh, God.
And what lessons could you say that you've applied from all of those areas?
I wish I could say it was all my master plan.
Yeah.
But really, there was some serendipity in all of that. And for anybody in the audience that might be thinking of venture as a career path, I would say that my path to venture is probably not one that many people are going to replicate. And venture is also notoriously difficult to kind of pursue as from here. I'm a freshman in college and I want to be a venture capitalist when I grow up. I mean, it's just an almost never. From every other GP that I've spoken to, they've never taken that path. It's always been kind of, well, I ended up in venture, but I was a marketing executive for 20 years, and then I got invited to join a firm or whatever. So, but to answer your question about my own path, so I was actually, a PhD student in archaeology. I was ABD. I had already done all of my primary research, and I was just getting ready to do my lab work and then do the write-up, and then I was going to be done. And then I got married. So my wife was coming from overseas. She was graduating with a law degree from France, and then coming here, found out that her law degree would be worth zero because it's a totally different legal system. And so everybody said, you're going to have to go to law school all over again and get a JD. And we looked at each other and tried to figure out how we were going to make all that happen. How was I going to finish my degree and she was going to do what she wanted to do? And so we had to make some painful decisions. And I said, well, you're coming all the way over here and having to adjust and do your law school all over again. So I'm going to figure out how to make that happen. So I said, I'm going to figure out how to support you and put you through law school. And so I had learned HTML as part of like a part-time job. Wouldn't really call myself a programmer at that point, but thought that was a good kind of spring pad to get into it. And this was the late 90s, so it was a really good time to transition into something else, because if you had a pulse, they would hire you to be a programmer. So I just got a bunch of books and locked myself in a room for 2 weeks and kind of came out with sort of the rudiments of it, and did that for about 6 years while my wife kind of got settled, and then went through law school and then finally got her JD. And then that was really the moment where I had to kind of decide, what am I going to do? Am I going to go back and get my PhD, or am I going to double down on being a software developer and try and get a graduate degree? Because I knew that there were a lot of things about the field that I still didn't know. And there was also some nagging concern that there were things that I didn't know about software engineering. And so is that the path? Or I also kind of toyed with the idea, maybe I should go to business school, because I was really kind of drawn to what are the imperatives that are driving these IT projects that I'm working on. So that's how I ended up in business school. And then ended up getting recruited not into product management, which is I thought was where I would end up. Out of kind of combined business school and software engineering and product management would be a great fit. That was my thesis going into B school, was that I would go work at a startup. But ended up getting pulled into private equity. I really liked that sort of mathematical nature of finance and was drawn to that, and then got an offer from a kind of a boutique private equity shop, and so ended up there. And that kind of got me in the path that ended up where I am today.
Yeah.
So
Cool.
It's kind of a long story. I'm sorry if
No, that's what was the question. So
yeah,
thanks.
that's how I ended up where I am.
Hi, I'm just curious about your venture firm. Specifically, what kind of deals you actually make. I know every company is different and every deal is different, but
Yeah.
just for example, say that you had a great tech company, early stage, maybe pre-revenue or just at the beginning,
Right.
and they have a very solid team, and you're interested, but there's not really that revenue there to tell you that there's serious proof. So,
Right.
At that kind of early stage, like, do you do a straight equity deal? Do you do some other kind of deal? And if you take equity, is there a sort of a minimum that you're looking for in a percent, or like what kind of range?
Yeah, okay. So a couple of things to note about that. First, for our company in particular, or our fund in particular, it would be a great time to have a conversation, to say, look, you guys are still a little bit too early. You're not quite in our strike zone. We want to see a little more revenue traction before we can actually talk about writing a check. But it's great to get on our radar and learn about your team and what you're doing, so that when you do get to that point, which may not be very long, you might be talking 3 or 4 months, if you have a really high growth rate, then we've already kind of laid the foundation of a relationship so that we can re-engage with you and talk about actually doing a funding round. And in terms of what kind of round it's going to be and what size, it also kind of depends on your funding to date. Because oftentimes what we see is they'll alternate between equity and convertible debt. It's a very common pattern. So if maybe you had a pre-revenue seed round that was a priced round, but you don't have enough resources to get to the metrics that you need to have a proper Series A, then we might engage with you. You've got a little bit of revenue at this point, but you need some capital to get your numbers up to a Series A. So that would be a great bridge opportunity, and that would probably be in the form of convertible debt. That would be a very common scenario. for the set of facts that I just laid out. So it really just kind of depends on where you are, what was your last round like, what are your current needs, where are you on traction, how far are you to the next big round, and so what would make sense for us. It could be debt or equity, and in terms of what we like to do, our initial check size could be as low as 250 or as high as $1 million, with the expectation that we're going to put more capital to work over the next couple of rounds. Mm-hmm. So we might put anywhere from 2 to 4 million into a company over its lifetime, if it's tracking well, of course.
And just a quick follow-up is when you're looking at a company like that, or even if they start bringing revenue in, I mean, do you all have a high respect for or consideration of patents? Like granted patents, is that a big deal to you, or do you feel that it's not the most important thing?
I would say it's good to have. I don't put as much stock in them as some people might, just because I haven't seen as much on the software side of things as you might see in a more of a hardware-based startup, and because patents can be circumvented or they can be challenged. So as an investor, you don't want to put all of your hope in the fact that the patent is somehow going to save you. I think it would be foolish. So I would rather have that kind of as a little plus, put that in the plus column, but that by itself is not going to really mean a lot. It's much more important to us that there's a compelling need in the market, the team can really execute, the product fit is there, and they just need some resources to be able to go and hit the market. That means more to us than saying that we have 3 patents.
Thank you.
So, yeah.
Hi, Brad. My name's
Hi.
Giovanni. Just want to say, first off, thank you very much for being here. I think it's a great resource for all of us aspiring student entrepreneurs.
Yeah, my pleasure.
And one thing that I've noticed is that a lot of people struggle from going from an idea to a minimum viable product. So what type of advice would you give us student entrepreneurs specifically to do that?
So in terms of how you actually develop the idea into a viable product concept, or in terms of funding, or
In terms
both?
of just getting that minimum viable product out,
Yeah.
I mean, I know that varies from industry
Yeah.
to industry specifically.
I'm a
but-
big fan of Steve Blank's work
Okay.
and that approach, the sort of customer development model for the stage that you're talking about. And so that would be, in terms of methodology, that's the approach that I would use. That may not give you as much specificity as you're looking for in terms of, how do you actually build it or how do you get funded at that stage. But in terms of how would I actually go around proving the demand side of it, which I think is really important, because you want to have some early indication that the customers are going to want what you're proposing to build before you actually spend the time and money to build something, even an MVP. And so I really like his approach of getting out of the building, talking to customers, figuring out what they want, talking to them about your proposed solution, and giving them some kind of proxy, whatever it is, to see if they are really interested in it. And some people, one of the approaches that they use are these sort of landing pages where you're trying to get people to convert in some way by giving you an email address or something, some kind of proxy that you can use as opposed to them actually purchasing the product. And I think you have to understand the limitations of what that really means, but it's something. It's at least an early, yes, I'm interested, I want to know more. That says something about what, but I think beyond that, you need to actually get in front of real people, decision makers, preferably who have a budget, and get their input, or potential consumers if it's a B2C kind of product. But I've been very drawn to the approach, the customer development approach. That's very much in keeping with the model that we were taught at Acton. It's a very kind of bootstrappy approach, which is fail early, fail fast. Try and solve the most important underlying assumptions as early in the process as possible. That's another thing that I take from that. Is sort of like, what are the things that really the 3 or 4 things that really have to be true for this to work? And try and tackle those as early in the process as you can to get some kind of validation on that.
Okay. So you talked, just a follow-up question, you talked a bit about how you actually invest in some pre-revenue model or businesses or pitch decks. Do you see, I think that's what you mentioned, by the way. Sorry, I might be wrong on that.
Well, I can give you some clarity on
And-
that, but go ahead. with your
Yes.
question.
Do you want to see some sort of initial traction in terms of market validation? Is that a very common theme? I'm assuming.
Yes, we
for those
want to see,
pre-revenue.
ideally, we want to see some revenue traction.
Okay.
So, in Austin, the kind of traditional benchmark is about $1 million annual run rate for sort of a Series A conversation. And we're earlier than that, but we're typically post-revenue. So we're somewhere in between, and that's a really mushy area, but call it like 250 to 500 kind of annual run rate. We want to see enough revenue traction that we actually have some confidence that customers really want this product, and we can actually get a handle on the pricing, because the pricing can change pretty dramatically once you go to market and you start getting those first customers. You might change your pricing quite a bit, and that has a big impact on your unit economics. So we want to have enough revenue traction that we have developed a little bit of confidence in the pricing model, so that we can kind of see, is this a viable business? And so we've invested in 20 companies across our two funds to date. Only 2 of those have actually been pre-revenue. And in both cases, the people leading that were people that have had significant wins in the past and were attacking industry that they understood. And so we were able to de-risk it from that angle and can concede a little bit on the revenue traction, if that makes sense. But by and large, we want to see some indication of actual dollars in as our validation, and enough that we can actually have confidence in it, not just we got one paying customer. We want to see a little more than that. But we're much earlier than the sort of traditional Series A, Series B venture investors, if that makes sense. But we're not like what a lot of people think of as sort of a seed fund where you're coming in pre-revenue. Maybe you just have an MVP. We want a little more than that.
Okay. Got it. Thank you very much.
Yeah, absolutely.
The +1 for the customer development and Steve Blank. SteveBlank.com, lots of free resources. Stanford professor, let me plug that. Yeah, great guy. We have time for one more question, if there's one more question from the audience. The introvert's turn. Now that I called it out, you won't come. Okay, great. Well, thank you for your time and attention tonight. I know you're all busy. Really excited to participate with you, and please stick around if you'd like to chat afterwards. Thanks so much.